Hi, I'm Jim Yent from Golden Years Advisors, the home of the Kairos Formula. And it's that time of the year again. It's January 19th, and it's time for us to do our kickoff. And as always, Teresa picked a great cartoon. What we have here is an investor, old school, looking at his old ticker tape, hanging outside Chairman Powell of the Fed's office, saying, "Hey, man, what are you doing with interest rates and inflation?" I thought it was great. Super job, Teresa. As always, we have over 30 different partners of research that we work with. And what we do is we gleam off a couple of their outlooks. So I want to give them credit where credit's due. City National Rockdale's outlook, the Morningstar Group, Clark Capital, sorry, my head's blocking their name, so they're not seeing the credit, as well as Yardeni Research. And we try to distill that down. What we're going to do is 3 videos. We used to do 4. We're trying to shrink it down, so they might be a touch longer. But video 1, we want to recap what happened in 2022 and share one of the favorite slides that our clients love at every kickoff. We call it the S&P Cycle Composite. It's a historical projection of what the year might look like. Then in video 2, we'll dive a bit deeper to say economically, as well as from a profit perspective, what's our outlook? We always like to give our best case, what's our most likely scenario, as well as a worst case and a better case of what it could mean for the economy and the markets. At the same time, we want to deal with one of the big questions, namely, is this going to be a recession or not, a deep one? So that's in video 2. Then in video 3, we want to put it all together, answer some of the key questions that we get all the time and bothering all of us as investors, talk about risk, then talk about portfolio positioning. So without further ado, let's jump into it. If we're going to look at last year, the best way to describe last year is 2020. That's when we hit the pandemic. COVID destroyed really the economy. From a GDP perspective, 1 quarter alone, GDP fell 35%. 2021 was kind of recovering from it. So 2022 was the full recovery. And as a result, as you can see on the chart, we had just extreme growth. 2% is what a normal economy like ours can do. We came out with 6%, 7%, 7%. We nailed it in 2021. So when we came into 2022, it wasn't as good. As you can see in that very first quarter, we actually went negative from a GDP perspective, about 1.6. My head's hiding it, but we were down about 0.6 in the second quarter of 2022. We'll still see, because the data was very confusing coming from stopping the world's economy to restarting. We think there was a lot of data errors, but in any event, people were worried that we were already in a recession. When we hit the third quarter, all questions were answered, no, that wasn't. And to this date, they haven't called the first 2 quarters a recession by the group that does that. They're kind of like the umpires that throw the flag. But we bounced back strongly with a 3.2 economy in that quarter. If COVID and the pandemic got people around the globe sick, and it's still doing it today, 4 years later, almost, what it did to global economies is it gave them a different disease. The disease is inflation. We haven't seen inflation like this in over 40 years. And at our peak, we hit about 9.1% inflation here in the US. We've seen double-digit inflations in other parts of the world. But since about mid-year, as you can see on the chart, inflation started coming down, which is good, but it's still way too high. 2% is the target that the Fed is always looking at. So if inflation is the disease that hit the economy, the cure that typically is handed out, or the reason why it happens in the first place, is an overabundance of money. And so what we're sharing here is M2. It's a measurement of the money supply. And that spike represented over a 27% increase in a very short period of time, the amount of money floating around the economy. And the reason why is every government around the world said, stop, stay inside, quit working. And as a result, handed out money. And in the United States, we did it to a very big degree. So inflation was the problem. The cause of it was an overabundance of money supply. But the way you cure it is you raise rates. And so we had an incredible increase in the 10-year Treasury. That's the pink line you're looking there. It went up over almost 179% in less than 10 months. And the 10-year Treasury is like the measurement stick for saying, is something priced fairly? Anything related to stocks or bonds or properties, you always kind of like the divisor, how you figure out the fair value is based on that 10-year treasury. Well, if something spikes more than 100%, like it did, it just wreaked havoc on stock markets and bond markets. The blue line that you see there, that's the Barclays Aggregate Index for bonds. It had its worst year in recorded history. The red line represents the S&P 500, a deep 20% fall, and NASDAQ fell even further, and other indices around the world similarly were just really strongly challenged. And if I were to try to sum up 2022 in one chart, it's probably this. The blue line represents that S&P 500. But one of the ways you see if a market is healthy is whether the current price is above either a 50-day average, that's the black line you see, or more importantly, you want it to be long-term healthy, that's the red line. And really what 2022 represents is, for most of the year, a bear market. That's why you see that big block of pink. That's that we were in a bear market last year. More than a 20% decline happened to the markets. But 3 times, and that's pretty rare. It's only happened 3 times in the history, like since the Great Depression, of having the market fall into a bear market. There's number one, a 10% rally, a second 10% rally, and then a third 10% rally. And each time you notice, it was trying to break through. The first time it did, but fell back quickly, but trying to break past that 200-day average. Well, guess what? Here it is, January 2023. And what are we doing again? I can't show it because that particular plot only goes through January 6th. But in the last couple of days, we blew past it again, right up to that edge. So we're trying to see if we can bust free. If so, that's a very good thing for markets. But we failed 3 times. So we'll see how it proceeds going forward. So that's what happened last year. Let's look forward. And this is the chart that we've been sharing with clients for over 15 years. We got it from Clark Capital. They often get it from Ned Davis Research, but it's called the S&P Cycle Composite. What they do is, it's not 100 years of data, but they go back from 1928 and they take three averages of the S&P. One is the annual of every year. How does it go during the course of the year? The second one is a 10-year average, looking through the course of a year, what goes on. And the third and final view is, well, what happens when it's an election cycle? You know, the 4-year presidential cycle. They smush that data together, and that's what we get, the composite S&P forecast for this year. And whenever we share it with our clients, we always say, look, we're not trying to time the market. And, you know, history, past performance, you know, doesn't guarantee the future. But if you were to say, what's the best way historically to see on average what this year might look like, this is the average of all that back data. And the way we would interpret it is this. We'd say, looking at that, well, historically, this should be an up year because it is going up over the course of the year. And we all can see it. Looks like the first part of the year is better than the second part of the year. Second part of the year, kind of flat going around. That's all we would take. And we would take it with a grain of salt. But as we've tried to share before, this year, the 3rd year of the presidential cycle, is the best calendar year for the market. You can see that pretty quickly because that's all 4 years of the presidential cycle going back to 1928. But more importantly, if you notice, the yellow area, from about where the presidential election is, whether it's a midterm year or it's a presidential election year, but the 2nd year of that presidential cycle at election time, for those 12 months, historically, that's the best part of the market. So we're in that portion of that cycle, and usually it's an encouraging year. Now, that doesn't know anything about what's happening in today's world. It doesn't know about COVID, doesn't know about Ukraine, doesn't know about where treasury rates are, inflation, but that's just a historical number to kind of put in the back of your head to say, we're in one of the better parts of how markets do. So here's the big questions that we want to address. And everyone's asking us all the time. Are we in, or are we heading into a recession? What will it take for equity markets to find the bottom? And more importantly, we all want to know, when is this bear market going to be over? We're not going to do it in this segment, but stay tuned. It's coming up in the next 2 segments. Talk to you soon. Stay tuned.